Hello, everybody. My name is David Ruff, where we teach you how to retire in 36 months if you can implement the plan. Today, we're going to be talking about one of the key strategies in this is understanding all of your revenue streams when you're buying an income property. Most people think that it is just the rent that it comes in, but it has so many facets to it. And this calculator is going to help you merge them all together. We're going to show you all of the steps that you can go through. It's really, really quick. You can go through 100 properties a day to find the best deal you can in the market. And we're going to go through those steps with you live, and we're going to show you some little tidbits that I use. This was a calculator that I built for my own use because I couldn't find it available commercially anywhere. This is the same tool that I use on a daily basis when we're looking for properties. Now, let's take a look at this calculator. There's a lot to it, okay? So we're going to go through it, and it's all going to make sense in a couple seconds, and you can refer to this calculator afterward if you want. There's also a definition of what the terms are in the top right-hand corner. You can go and review. So the first note is you're going to be filling in just the yellow cells when reviewing a property. You're going to change this right here. We're going to put in the price of a property that you're going to be considering to buy. Maybe it's $600,000. Let's say that maybe we can leave this. Current rents are $4,500, and the optimum rents, let's say when you're completely done, might be $5,200. Perhaps you're going to be changing the floor, putting in new windows, or putting in new laundry machines, something like that. So if that is the case, then maybe I'm going to leave this. Maybe it's $5,000 a year in property tax. Maybe it's $250 a month in insurance. Of course, you have to have your quotes to be able to put that in. Now, the next section here, gas, water, sewer. Obviously, gas, water, and sewer is going to depend on if you have common elements. So what does that mean? If you're in a building and it's 4 floors, it has a staircase going up, hallways, then you're going to have heating in those hallways. You're going to have electricity to pay for, and you may not have an HOA, a homeowners association, or a condo corp set up. So you're going to have to be funding that as a landlord. So that is where you're going to put those ones in. Maybe you're including it in the rent. It's up to you. In addition, when it has condo fees, if you're in the US, this is what they would call homeowners association fees. Lawn and snow, obviously, if you're in the north of the United States or in Canada. Property management, 9%, vacancy 5%, and repairs 8%. A couple things that we have to talk about that. So property management typically is 20%, 25% if you have an Airbnb, for example, and they might do cleaning for you, booking for you, answering questions. It depends what level of service that you want for that. Also, when it comes to just a personal 12-month long-term lease that you're running with people, typically speaking, they're going to be charging 10, 11, 12%, something like that. But if you are in bulk and they have a bunch of them, you probably could get it down to 9 or 8% if you have a lot of properties in the same place and you use one property manager for the whole thing. Second note is when we come to vacancy, every market is unique, and it doesn't even mean by area code. We're now talking about entire ecosystems within that area code, meaning a commercial vacancy would be a different than residential vacancy, different from a dentist shop or a corner store, and it may all be in the same block. So we really have to know what we're going to be expecting. In the majority of the markets that we work in, the vacancy is very, very low. It would be less than 1 month a year, maybe 1 month every 3 years. So if that was the case, you can adjust your vacancy percentage down. So typically speaking, when you're running the numbers, you're generally going to be using 5%. Last but not least, repairs. Repairs are going to fluctuate up and down. Now, let's just imagine again, we're in a building and it has one roof for 20 units below. It's a more expensive roof, but overall for the number of units, it's less roof. Imagine you had 20 different houses, more roof. So generally in a larger building, you can afford to get a little bit lower percentage on repairs. But if you have a small building, $100,000, now all of a sudden you have to put more than 8%. You might be at 10, 12%, depending on how much capital expenditures you're going to have to put in the property. So let's go back to this, and I'm just going to use a typical property management. Might be 9%. That's pretty accurate. 5% is the average. 8% would be average. Remember, I said there is possible to go higher and lower. Down payment is going to be 20%. We're going to have 80% mortgage. Interest rates right now, we're now in January of 2023. Right now, 5% is quite accurate. In addition to that, we were going to look at 25-year amortization, and maybe your lawyer is going to cost you $2,000. obviously you can alter it. Remember I said just do the yellow squares. So we did the yellow squares, and now everything else on this page will have auto-populated itself. Now, there's a couple of assumptions that we have to make. There's only 4 more boxes that you have to look up. First box here is improved value, assessed value ratio. Woo! What is that, you guys? All right, so if you're looking for the improvement value, this is for tax codes. There's a book by Tom Wheelwright called Tax-Free Wealth. You have to know what depreciation is. In the US, you can get the US calculator version of this. In the US, it's called depreciation. And we actually even have something called bonus depreciation. But in Canada, we call it capital cost allowance, or CCA. And so it's measured in different ways. This is incentives from the government where they're giving you money to buy the things that they need. I get this question all the time about this stuff. When I was in one area where my mom came from in Sault Ste. Marie, maybe you guys know it, it's in Northern Ontario, but it doesn't matter. There was a reserve that was there, and the government was building homes for all these people. The cost of building a home was $1.2 million, yet a home in the area would only sell for about $200,000. So you have to ask yourself, why is it $1 million more? The answer is governments are very inefficient. So the governments will have to subcontract to a large company, a smaller company, smaller, and they may have to subcontract 10, 12 times before they actually get the home built. That's why the cost is so high. So the easiest way to get anything done in a country is incentivize it. They just have to give a couple dollars to some investors, and then they're willing to go out and take all the risk and build the properties and do it all for them. Governments know that it's a much cheaper way to get things done. And this is where this money comes from, where the governments are giving incentives to lower your tax rate and even lower it down to zero if you use it all for your own benefit. That is why they do it. But let's look at this calculator. What is the improved value as a percentage? Notice here it's at 60%. What does 60% mean? 60% means the building is worth 60% of the purchase price. How do you get that number? You're going to get that number by talking to your insurance broker who got it. They're going to have those numbers for you, or the city tax papers that normally come to you will say what the value is. They'll say land value is 30%, or they're going to say land value is 40%, or they're going to say improvement value, and that's going to be the building, the sticks and bricks that it goes to make up your property. That's what you want to know, because the government realizes that your home wears out over time, but land doesn't wear out. So you don't get a write-off on the full $750,000 that we put down here, because a big chunk of that is land value. You only get the part that is of your home. So this is where you got to get this percentage, okay? You got to talk to your tax guys and get that improvement value, and whatever your tax rate is right now, you have to put in your tax rate. That's going to help assess what the value is. Notice over here, your principal pay down is already taken care of. Last 2 adjustments. What do you think is the average yearly appreciation of properties in your area? Now, you can talk to a good agent in your area. You can talk to a mortgage broker. You can look at the National Realtors Association. They have forms on it, Axios, or you could just go from your personal education in the area, how it goes. In big cities like Toronto and New York, we'll have big swings where properties are up 20% in a year and drop 20% in a year. Other areas are very low and steady and may only go up 5% per year every year. And so you can adjust that. Maybe we're going to put 5% appreciation to be safe, and rent growth. We're putting 5% here. Now, it really depends where you go. Depending on the city and the state that you're in, it can be guaranteed by the different province or state saying that you cannot be over 1.5%, 2%, something like that. And they call that rent protected, or it could be just the Wild West. Whatever the rent is, it is what it is. So you have to see where this is going to take you. And remember, the average time that people live in a home is 3 years. So every 3 years, in some areas, you can bring it back up to market rent. Other areas like Quebec in Canada or New York, you can't always do that. You have to base it on the previous rent. So you have to know what your rules are in your area. But we have to make this assumption and say, what do we think appreciation is per year? And what do we think rent growth calculator is up per year? Now we're done. Okay. Whew. This is it. So when you're going to buy this, I can do this really fast. I know it takes a bit longer when I'm explaining it, but you put the purchase price and rent that you're going to rent it for, put in your taxes and insurance. This pretty much stays the same, property management, vacancy, and repairs. And this pretty much is staying the same. If this stuff is staying the same, remember, I got to put in 1, 2, 3, 4 numbers. and most of it will all be the same. So we've made some assumptions. We already know in our area maybe that we're targeting what the building value to land value ratio is. We already know what our taxes are going to be, and we've made our assumption on rent growth and yearly appreciation, and it will now pump it all out for you. This is the number that you're going to be laser focused on, 51% that you're going to make in a year on your money. So here it is, down payment, $120,000, and you would have made $62,000 in your first year. So how does it do that? Well, it's going to add up all your calculations way down below, down here, total return, and it's pulling the numbers from here. But let's go through each calculator that is in here. So this calculator right here is just showing off to you how much money that you're going to make. But to make 2,000% in 20 years, this is pretty exciting. I have to put out, notice here, $120,000 out of pocket, and it's going to pay me $2.3 million in 20 years. That is exciting. You can now retire off of something like that. So let's figure out what the calculators are. The very, very first calculator that you're going to be paying attention to is this current cash flow and cash flow using market rent. So this is auto-populated. You're not filling anything out here. It has the purchase price, 80% loan to value. This is the down payment. This is your legal costs. It's pulling right from here. The principal that is here, this is what you're going to have a mortgage for. We put in the 5% in 25 year. It's already pulling it right from here. And then it's going to give you what your monthly mortgage price is. Then you have your monthly net, yearly net, and your yearly ROI. Obviously, from current rents today to what we're planning to bring it, we can see how much improvement we're going to bring here. So over on this side, the one thing that people don't usually pay attention to is it's going to have your property management fees, taxes, insurance. But notice this right here, these two numbers, 225 and 360. If you add that up, 225 plus 360, it's going to be giving you $585 per month in a year. That's giving you $7,000 for vacancy and repairs. So it's as if you have another account that this $7,000 a year is getting stashed into. But in a lot of our areas, the properties don't need any repairs and the properties are not empty. So then what do you do with that $7,000? It just stays there. It's still your money. And this calculator does not calculate if you needed that or not. It's calculating as if you're burning through that $7,000 every single year. So you can reinvest that money if you want and have it available. Whatever you need to do with it, you can do. Notice that it gives you your cap rates here, your total operating expenses. So these are the calculators. So this is current cash flow, optimum cash flow. Notice that we put it up here, current rent, optimum rent. Cool. So now we understand this calculator. Second calculator is right here, the 20-year debt paydown. Some people call it principal paydown. When you have a mortgage, you have two portions of your mortgage. One part is interest, one part is principal. It's the debt. It's the mortgage that you have on that property. And so every single month that the tenant is paying you, he's paying the interest and he's paying portion of your principal. And so the principal is money that you're making on the back end. Think of it as a business. You have money coming in. That's the principal part is coming in. But the interest that you are paying, that's a business expense. And business expenses are write-offs. So let's head back to this. We can notice that in the first year, you have the most debt. So you're having only $9,800 of principal paydown. So that is your money that you get to keep. In year two, you've paid a lot of money off of the initial amount. You've paid $9,800 less, so it's less interest. So the second year, you're going to make $10,400. Third year, 11,000 almost. Fourth year, 11 and a half. And it keeps going up. This goes down full 20 years. If you didn't do anything and you didn't renegotiate and you didn't refinance 20 years down the road, I think you should refinance every 3 to 5 years. But if you didn't do anything, now it'd be up to $25,000 total debt pay down every single year. If we move over to this calculator, we can see that there is many years here, 1 to 10 on this side, years 11 to 20 on this side. gets kind of exciting because they're getting bigger and bigger numbers. In Canada, it's called capital cost allowance. Depreciation in the United States, please talk to your CPAs, talk to your financial advisors about using depreciation and all of the skill sets that you need on how to use capital cost allowance. You can use 1031s exchanges in the United States, but remember in Canada, we have recapture, but please talk to your advisors about that. So it'll calculate the total interest that you are paying, also the write-offs that you get using depreciation. In Canada, you get a big boost in year 2 because you don't have the half year rule in year 1. So that'll be important. Your average yearly appreciation we have in our first year, here is the estimated value of your property. And it is saying if you go up 5% a year, maybe it's going to go up 30 grand. And then it compounds itself every single year. And it's nice to see these numbers climbing every year. Now it's basing this gain based on your initial investment. Your initial investment, do you remember at the very top here, down payment was 120,000. So it's measuring what is 30,000 of the 120,000. Well, that would have represented a 25% gain cash on cash there. Also, we had already made that assumption 5% for our rent growth calculator. And we know that it depends where you live, obviously, what city, what state, what province. But some places have controlled market rent, and some places you can do whatever you want. Look at National Association of Realtors, look at Axios or some type of graphs, or talk to experts in the area, mortgage agents, real estate agents, and figure out that percentage. What is consistent? So when you come down here, it's giving your total return now. We went through cash flow, which was at the very, very top, way up here, when we're looking at all the money's coming in and the money's going out. Then it talks about principal pay down. That's the portion of your mortgage payment that is principal, or we call that debt pay down, which is this one. The third one was your tax savings, and that is tax savings with your depreciation or capital cost allowance. You see, we're keep on adding to all these different things. And then we have the appreciation of the unit. This is all helping you. It's going up and up. Remember, your cash flow is being adjusted higher and higher every single year because the rent is going up every single year. So we now have all of this that is aggregating it all, but it looks exciting when you look at it, 62,000, 69,000, 73,000, and it goes up and up every year. But remember, you don't get all that cash in year 1. When can you pull that out? A lot of this money, like the appreciation of the building, you're not refinancing your building every year. At least I hope you're not. You may have to wait 3 years, or you might have to wait to year 5, whatever it is, your term that you have decided on, then you can go refinance your property. And that's when you're going to be able to recapture a lot of this money. And remember, you don't pay taxes on debt, right? And so you'd be pulling that money out of the property and putting it to work in even more properties. All of those numbers that we had down here, where it was accumulating all the numbers, this is where it is putting it up way up here. Again, we went through each one of those calculators individually, but just let's play a game here. Imagine it was 750,000 is the price of the property. Say that we're going to rent it for $6,500 optimum rent. Say that the taxes were a little bit higher and it was 6,000, and say that insurance was more and was 325, let's say. Now it's already given me my numbers. Now I already know exactly what my numbers will be, because remember, property management stays pretty consistent. Vacancy repairs is pretty consistent. The percentage is pretty consistent. And if we're targeting the same area, the likelihood is your improvement and marginal tax rate hasn't changed, and neither has the rent growth or appreciation changed. So did you see how fast I did that in seconds? If we're going to do that again, we have other properties, let's say in Toronto at $1 million that are renting for $8,000 per month. Now, I want to know right now, that might cost me 7,000 in property taxes and maybe 400 in insurance. Maybe it's a high insurance location. Remember, everything else stays the same. We're now hitting 49% on our money. So if you're targeting the same area, there's not very many numbers that you have to change. You can get these numbers really, really, really quickly. So in the past, you guys, what I was doing when I was looking at properties is I would have to figure out all the income streams. And so this doesn't include all of it. We haven't talked about what you do when you're going to reinvest the money after you get a refinance on your property. It doesn't include what you're doing with the reserves for repairs or vacancy. It doesn't talk about any of the strategies when it comes to recapture or 1031 exchange. But all of the things that I'm telling you are ways for you to optimize this even more and make even more money. What about value adds? If you put cell phone towers on your properties or put up billboards, or if you're going to add parking or extra bedrooms or new floors or laundry or whatever, it's even more money coming in. What this is giving you is this base of the basic income streams that you have coming in, and everything is building on top of this. But you need to have this to be able to go through properties really, really quickly. In the past, I would have to figure out what my principal was and figure out what my interest was on each payment and try and figure that out and figure out what the rent growth in the areas are. And this can make it so, so simple for you. It's so laborious to look at one or two properties in an entire day. This way, you can look at 100 properties in a day. Anyway, I congratulate you for taking your first step to building your wealth and retiring a lot quicker. This tool is going to help you so, so much. If you love it, I would love for you to leave a comment for me and let me know what you do love about it. If you don't like it, let me know what you don't like about it. Whenever you buy this calculator, it's lifetime access to it. So if we ever have new updates or we're making it better for you, it gives you that access all the time. Anytime we make a new one, you're going to get it as well. So I wish you your very best. We have a lot of tools that will be coming out this year to help you build more wealth and hopefully retire really, really quickly. Anyway, my name is David Ruff. Thanks so much for coming by. We really appreciate it. Have a good day.